Hello, everyone. Welcome to another episode of Inquisitive Finance. I'm your host, Rafael Negron. So today I'm excited because I'm using a tripod. Now, before I use my tripod, let me show you what I was using. What I would do before is I would sort of prop up my phone on this little case I have right here. It's just a little box of goodies. I would prop up my phone on this to make sure that the iPhone on this little tripod I had was high enough so it can get my face. But what happened because of that was the desk started wobbling a lot. So many of you, or at least maybe some of you, may have noticed that the video was wobbling if you sort of paid attention. But now with the tripod, it's on a still surface. I don't have to worry about that. So that's kind of exciting. Just little things that I try on every once in a while. I also have my microphone a little bit closer to my mouth. So hopefully you'll get less reverb. You might see me hunched over a little bit to try to make sure I'm still talking. And I'll be looking over at the levels every once in a while. But hopefully the audio sounds good. I tried to do a lot of test videos beforehand to make sure everything sounds fine. And, it is what it is, but we're always experimenting, always learning a lot on this channel, not only about finance, right? Just about the whole YouTube process. You can see here, it's a beautiful day in South Florida. Always very nice to see the sun out. It's always nice to be able to film during the day instead of at night. Again, it just gives a different ambiance. And I think that's about it. That's all about the sort of, let's say, housekeeping I want to do before getting started in the video. Today's topic is going to be real estate investment trusts. It's something that I've known about for a while. I was even invested in some of them for some time. I'm currently not invested in any of them, but I at least wanted to learn a little bit more about them and why someone might choose this fund over, let's say, like a growth fund, for example. And I want to start the video with a post on my Twitter. So there's someone that I follow recently. It's crazy. It's this 19-year-old guy called Carson. And he is just killing it. Okay, this guy's 19 years old. He has a portfolio of already in the six figures, over $100,000. One of the first people that I followed. I think he's also one of the first people that followed me. So I think it's kind of cool just building up that Twitter profile. I also have my Twitter profile linked to my YouTube channel, and I'll try to start putting it more in the video description. So if you want to join me on Twitter, I sort of talk a little bit more about finance there and really just anything like gaming or working out or just random other things. If you just want to hear more from me, feel free to follow me on there. But anyway, you can see here that I had originally asked this question: does your employer offer an employee stock purchase plan, ESPP? If so, are you contributing to it? How much? I think it's another example of free money that doesn't come around often, so it's advantageous to take part in it. And Carson responded, I don't get anything besides an hourly wage and a 401k. I can't even contribute to the 401k till I'm 21, so I max out my Roth IRA, which prompted me to respond and say, man, I can't believe at 19 years old, you're already maxing out your Roth IRA. I mean, that's a phenomenal place to be in. And maybe Carson doesn't understand yet how much, he has the greatest asset on his side, which is time. But I think this was just very, very interesting. There's people now, the resources that we have nowadays are so different from when I was growing up. Maybe when I was growing up, investing was as easily available as it is now, but I didn't really get so involved in investing till around like 25, 26, 27. So for someone to be 19 years old already with a net worth of over $100,000, who knows when they started, with tools like ChatGPT and AI in general and just YouTube, there are so much more resources now to learn about this type of stuff. So if you're young like Carson, then by all means, you can get invested early. And maybe this is someone you want to reach out to as well. Maybe follow them on Twitter if you also have a Twitter account. Anyway, I asked him what he invested in. He mentioned VOO, VXUS, and O. Now, O is not something I was very interested in, nor is it something that I even knew anything about. But you can see further down here, he explains his conviction for O, for example. He says, I own O for real estate exposure and downside protection. I want to use that dividend stock to reinvest into O and grow that monthly check. So it kind of prompted me to make this whole video, and that's exactly what we're going to get into now. So without further ado, you guys know the drill. I have my notes right here, and we're going to start getting into them. So what are REITs, and why would you invest in them? You can see here I have my Twitter link, which is the first thing I just showed. And now let's get into the basics, right? So what does a real estate investment trust stand for? Well, I just said it, right? The REIT stands for Real Estate Investment Trust. And a real estate investment trust is a company that owns and or operates income producing real estate, from what you can see right here, right? So I want you to think of things like apartments, shopping centers, warehouses, or office buildings, okay? The first time I actually ever was involved in a REIT is when I looked up it's not a REIT in and of itself, but it's something like Simon Property Group. So at least in my area where I grew up, There's a lot of these different types of malls which are owned by Simon Property Group. They all sort of have their own style, so it's very easy to tell when it's a Simon Property Group mall. Perhaps I'm sure they're not just in Florida, but I'm not really sure. It says the largest owner of shopping malls in the United States, and it's headquartered in Indianapolis, Indiana. So odds are they're probably in other areas as well. But this is kind of how I first learned about it, just thinking that I can invest in something like this, right? And one of my managers where I work, from having conversed to him about Simon Property Group, started telling me about REITs, real estate investment trusts. So again, apartments, shopping centers, warehouses, or office buildings. Now, the trust in an REIT is different from a personal trust, which is used to manage and pass down personal assets. By the way, if you want to learn a little bit more about trusts, I made a series of videos of how do you, let's say, handle your money at different income brackets. One of these videos is you finally make serious money, but are you using it right? And I'll leave sort of one of those links on the top right of the video so you can go ahead and click on it. But I have a chapter here that's called estate planning. And in this chapter, I talk about things like wills, beneficiaries, and a basic trust setup. So if you want to learn more about trust, I highly encourage you to check out this video where I've already sort of talked about this. And if you want me to go even deeper into it, it's something that I'd generally be very happy to learn more about and do that for you all. So it's also a historical term that dates back to the 1960s, allowing for investors to pool money to own real estate. And I actually looked this up in Wikipedia. Let's pull up the article for real estate investment trust. So if we just look a little bit here in the, let's say, creation section here, let me zoom in so everyone can read this well. Also, always need to make sure that my face is not covering. But here we go. REITs were created in the United States after President Dwight D. Eisenhower signed Public Law 86779, sometimes called the Cigar Excise Tax Extension of 1960. The law was enacted to allow all investors to invest in large-scale, diversified portfolios of income-producing real estate in the same way they typically invest in other asset classes, through the purchase and sale of liquid securities. The first REIT was American Realty Trust, founded by Thomas J. Broyhill, cousin of Virginia U.S. Congressman Joel Broyhill in 1961, who pushed for the creation under Eisenhower. So I just thought it was kind of cool to read up on that history, how it was created, and understand that it's not like a personal trust, right? Used to manage and pass down personal assets. It was just a different way for investors to pool their money to invest in something together. Now, REITs, they earn money from rent, not from selling products or services. So you can think of the REIT like a landlord at scale. And I was thinking of a way of drawing this. This is not something that I practiced beforehand, but the way that I kind of see it is you can imagine you have, let's say, the REIT in the middle here. And then around the REIT, you have all these different types of, well, categories that we just talked about, right? Let me make this a little bit nice. This is like a weird looking circle. But let's say here you have shopping. Can I make this a little bit bigger? Shopping right there. What were the other classes? One of them was warehouses, right? Warehouses. If we go back here, just to look at the different office buildings, apartments, right? So let's just include these here. We have office buildings. We have things like apartments. And you can imagine that this REIT, like I said, it's a landlord at scale. So just like you, let's say, like me, for example, at some point, I'd love to rent my current home out and I become a landlord. But the REIT is sort of like a landlord at scale. So it's collecting rent from all of these different entities, right? We have an REIT collecting rent from apartments, from shopping centers, to office buildings, to warehouses. So by you investing in this REIT, you're kind of also appreciating all that dividend income from all these different rents the REIT is collecting from these different categories: apartments, shopping, office buildings, warehouses. I just thought this was kind of like an interesting visual. It hopefully will put it in your mind and allow for you to understand it a little bit better than just seeing like a word on paper, okay? So if we go back down here just to see here, it leases properties to tenants who pay rent each month. This is in contrast to Apple, for example, who makes their money by selling iPhones and subscriptions, right? You can think of other companies like Apple, they're selling their iPhones, maybe a company like, let's say, Xbox or Nintendo, they're selling physical products that people can actually buy, whereas an REIT is leasing properties to tenants who pay rent each month. Sort of how I guess you'd be your own landlord if you had your own property that you were renting out for others. Now, the rent money minus the expenses is what gives REITs the cash flow to pay the dividend, right? So after they have all this rent money, they've paid all their expenses, then they have this hopefully positive cash flow that they can use to then have this dividend investment for all the investors that are invested, a lot of investment there, into the REIT. So very interesting to think about. Now check this part out. It's required by the US tax law to pay out at least 90% of its taxable income to shareholders as dividends. So this allows REITs to avoid paying corporate income tax, which is why they can offer such high yields. They're known as pass-through entities, and the investors themselves pay taxes on the received dividend. Okay, they figured, and I'm using they sort of loosely here. So because these REITs are already giving so much of their income away to the investors, it's like we might as well just tax the people that are appreciating that dividend. So this is known as a pass-through entity. This is probably a whole topic in and of itself. I'm not a tax lawyer. This is not really the point of these types of videos. If you want me to go into this, I may or may not do it. I'm not entirely sure. You're probably best served by talking to someone who's more into taxes, or maybe looking up one of those videos, learning about what exactly a pass-through entity is. But it's pretty much just saying we're going to remove the responsibility from the REIT of paying this income tax to the dividends, or rather to the investors themselves, since 90% of it is going to them anyway. Might as well just have them pay it. Okay. Now here's an interesting piece here. Because REITs typically pay 4 to 6% in dividends, they can generate a lot of income, but that also makes them tax inefficient in a regular brokerage account. Their dividends are not qualified, so their tax is ordinary income up to your full marginal rate, which can be as high as 37%. Now, this is why REITs fit perfectly inside of a Roth IRA. In a Roth, those monthly or quarterly dividends compound tax-free, and you'll never owe tax on the withdrawals in retirement. The Roth essentially turns a tax-inefficient income asset into a tax-free compounding machine. Now, of course, I also made another video about this, which I think to date is one of my most popular videos. So thanks to everyone who has watched the video and left comments on it. It's called Where to Invest for Maximum Tax Efficiency, Roth versus IRA versus brokerage versus HSA. Now, this is something that was very eye-opening to me, because it's one thing to sort of learn about what funds or maybe individual stocks to invest in, maybe things like FXAIX, for S&P, maybe like an REIT, a growth fund, a dividend fund, for example. But it's also just as important, I would say even more important, to learn where to invest these things, right? So something like a dividend, which is generating a lot of income, if you put it into a Roth IRA, you won't have to pay taxes on that income, right? You won't have to pay taxes on those dividend reinvestments. The Roth IRA is sort of like the supercharger of all your accounts. That's why it's limited, right? I think the current limit is 7,000. Next year, I believe they're increasing it to 7,500. But you can imagine with a vehicle like this, you can really grow your money quickly and tax-free and really appreciate all those compound gains. So putting something like O, that's the ticker symbol that we're going to talk about today, or in more generally an REIT into a Roth IRA, you don't have to worry about paying taxes on those dividends. So watch this video right here. I just realized I didn't have it on the screen, but watch this video right here if you're interested in learning more about where you can invest your funds and why different accounts can make a world of difference and possibly save you, thousands, tens of thousands, maybe even hundreds of thousands if you have a long enough time horizon. Okay, so let's keep going here. And of course, for that video, I will leave a link on the top right, so you can just click on it right away. You don't have to worry about finding it yourself. Okay, so why is realty income, ticker symbol O, so special, right? If we go back to Carson's post from earlier, we saw that he was specifically invested in O. Why is O so popular? Well, realty income, ticker symbol O, is one of the most popular and respected real estate investment funds in the market. Here's why investors love it. It focuses on commercial real estate, especially single-tenant retail properties. So I want you to think of things like Walgreens, 7-Eleven, Dollar General, and we can actually look at their fact sheet and just look at a little bit more of what they're invested in. Let me see if I can just close this piece off. Yeah, there you go. I just wanted to get that a little bit more in the middle here. But we can see here we have the company description. It says Realty Income, the monthly dividend company, is an S&P 500 company. For over 56 years, our investors have enjoyed monthly dividends, which have steadily increased over time. The monthly dividend is supported by the cash flow from over 15,600 real estate properties, primarily owned under long-term net lease agreements with commercial clients. Founded in 1969, the company serves clients as a full-service real estate capital provider. Realty Income became a New York Stock Exchange NYSE public company on October 1st, 1994. Now, I'll leave a link to this fact sheet in the description below if you want to learn more about what O actually is. But if we just scroll down here, look at some of the clients, top 10 clients, we can see 7-Eleven is the top one, 3.4%, Dollar General at 3.2%, Walgreens at 3.2%, Dollar Tree, Family Dollar at 2.9, Lifetime Fitness, EG Group, Wynn Resorts, places that you very well may have heard of, right? Let's look at their property diversification. They're 79.9% in retail, in industrial, 14.6%. They're even in gaming. I didn't even know this, 3.1% in gaming. And if we look at their industries, we have things like grocery, convenience stores, home improvement, dollar stores, restaurants, and quick service. So you can see that this is a landlord at scale. By you investing in REIT, you're investing in all these clients and you're establishing this diversified portfolio, right? If this is something you're interested in. So I'll leave a link to this fact sheet. I think this is one of those things that take you from basic investor to like level 1, level 2. You're at least definitely gaining levels by reading fact sheets. You're doing more than, let's say, the average Joe by doing this. So hopefully this is, again, imparting some wisdom on all my viewers. That's typically what I always want to do. Okay, continuing on here, it uses a triple net lease model where the tenant pays the property taxes, insurance, and maintenance costs. So this gives Realty Income stable, predictable cash flow with very little overhead risk. It's famous for paying dividends monthly, not quarterly, earning it the nickname the monthly dividend company, like we just read about in the fact sheet. And it's known for its incredible consistency. Decades of uninterrupted, slowly growing payouts, even through recessions. This combination of reliability and monthly income makes O a favorite for long-term income-focused investors, and it's part of the S&P 500 Dividend Aristocrats. So let's quickly read about what that means here. The S&P 500 Dividend Aristocrats is a stock market index composed of the companies in the S&P 500 index that have increased their dividends in each of the past 25 consecutive years. It was launched in May 2005. There are other indexes of dividend aristocrats that vary with respect to market cap and minimum duration of consecutive yearly dividend increases. Components are added when they reach the 25-year threshold and are removed when they fail to increase their dividend during the calendar year or are removed from the S&P 500. However, a study found that the stock performance of companies improves after they are removed from the index. The index has been recommended as an alternative to bonds for investors looking to generate income. To invest in the index, there are several exchange-traded funds which seek to replicate the performance of the index. One example will be NOBL by ProShares, which is traded in BATS. So this BATS Global Markets is a global stock exchange operator founded in Lenexa, Kansas, with additional offices in London, New York, Chicago, and Singapore. Now, if we look at the components, right, there are 69 companies in the index, with communications being the only sector this is unrepresented. If we scroll all the way down, we can find our O right here. So O, Realty Income, it's for real estate. So you can see that O is one of these dividend aristocrats, and like I said, they have increased their dividends in each of the past 25 consecutive years. So that's why a lot of investors are so interested in them, right? Going back to this, it's the combination of reliability and monthly income that makes O a favorite for long-term income-focused investors. You have this decades of uninterrupted, slowly growing payouts, even through recessions. Again, if we go back, I want to just go back to Carson Talks Money here, his post. He even said it right here. I own O for real estate exposure and downside protection. Okay, that's exactly what we just talked about here. In those bear markets, when the market is volatile, you can depend on that dependable income every single month. And especially like a company with a dividend aristocrat, they've been doing this for the last 25 years, increasing those payouts. Okay, so now, this is probably the most important part here. Why choose a dividend or income growth fund? Why not just invest in growth funds and sell 4% per year during retirement? This is what's known as the 4% rule, okay? I'll probably make a video on this, just this, because this could be a video in and of itself, but really quick, the 4% rule, how much can you spend in retirement? So let's talk about this, how the 4% retirement rule works. One frequently used rule of thumb for retirement spending is known as the 4% rule. Let me zoom in here a little bit. It's relatively simple. You add up all of your investments and withdraw 4% of that total during your first year of retirement. In subsequent years, you adjust the dollar amount you withdraw to account for inflation. By following this formula, you should have a very high probability of not outliving your money during a 30-year retirement, according to the rule. For example, let's say your investment portfolio at retirement totals $1 million. You would withdraw $40,000 in the first year of retirement. If the cost of living rises 2% that year, you would give yourself a 2% raise the following year, withdrawing $40,800 and so on for the next 30 years. The 4% rule assumes you withdraw the same amount from your portfolio every year adjusted for inflation. So pretty much this is just a way to make sure that you can continue living in your retirement safely, that you pull out just the required amount of money to make sure you still have money for the next 30 years. So why wouldn't someone just go in this model, right? You have all this money you've attained throughout your wealth accumulation phase. Now you're entering your, let's say, preserve phase, your maintenance phase. Why wouldn't you just follow the 4% rule and do that instead, right? I mean, theoretically, you can make a lot more money by just investing in a growth fund, right? Why would I invest in something like an income fund or a dividend fund when I can potentially make a lot more by doing a growth fund? Well, let's talk about that right now, right? It says, you absolutely can and many do, but dividend investors see things a bit differently. And here's the contrast. With a growth fund, you build wealth by letting your investments grow and selling shares later for income, which is the 4% rule we just talked about. It's flexible, but it requires planning, rebalancing, and sometimes selling during market downturns. With a dividend or income-oriented funds, you get a steady stream of cash flow without needing to sell anything. It can feel more comfortable psychologically, especially in bear markets, and people often find it easier to spend dividends than to sell their stocks. Dividend growth funds aim to raise payouts every year, sometimes 5 to 6% annually, which often outpaces inflation, which makes them appealing for retirees who want rising income without constantly adjusting their withdrawal rates. A portfolio designed for yield produces consistent cash flow. There's no need to time sales or worry about withdrawing during a bear market. The income simply accumulates for living expenses automatically, and it's great fit for people who prefer passive, predictable income in retirement. Now, I think this last line is very, very important, okay? So if you are someone, I think it always boils down to what your risk tolerance is, how you see yourself managing your money in the future. If you're someone like, for example, you've read that book, The Simple Plan to Wealth by J.L. Collins, he's very much of the mindset that there are some people that just want to set it and forget it and not think about anything. There are some people that are like that, and there are some people that, if you're watching this video, you might be more in the camp of you're interested in your money, right? You want to see where you can optimize. You want to figure out what funds to invest in, where to invest them in, what types of accounts. You want to look into things like REITs and trust funds and all the other things that we've talked about to this channel. You're definitely on the other side of the spectrum, I think, where you want to optimize for the best returns. So if you are someone that feels like you're okay with managing these accounts the older you get, potentially maybe even hiring someone to do it for you, though I would probably recommend against that. Again, just make sure you're not paying so much for someone to do this for you when maybe you can just learn to do it yourself. If you don't want to have to worry about how much should I sell in a given year, if the market's up, if the market's down, and you just rather have that dividend income you can just rely on and sort of set it and forget it, maybe a dividend income, let's say REIT style fund is more for you. But for someone like me that I think that is okay with doing this 4% rule, adjusting when necessary, if the market goes up, that's good. If it goes down, I have to worry about that then. Maybe I'd rather invest in a growth fund than something like an REIT. Okay, it would be very nice. I don't know if I want to do this live per se, but how much can we generate in, let's say, doing a growth fund versus something like, potentially in the next 30 years. I'm not sure. Maybe that's an easy calculation to do, but I would encourage you actually, as a bit of homework, do the calculation yourself. Do a simple Google search and see how much you can make potentially. No one knows what the future holds, but maybe using historical data, which I know sometimes is not great, see how much you can actually gain from going pure growth versus going pure dividend income. Remember, you're going to be getting some growth from the dividend income, and you're also going to be getting that dependable monthly paycheck. So again, you really have to decide where you fall on the spectrum and just make sure that whatever it is, it works for you and your family. That's the nice thing about all this, right? It really just boils down to you. I can tell you something, Carson can tell you something, anyone can tell you something, but you really have to sit down, think for yourself how you want to manage your money, grow your money, and preserve your money. So with all that said, as a wrap up, so growth funds build wealth. Dividend and REIT funds distribute wealth. Both work and serve different purposes. If your goal is steady, predictable income, especially in retirement, an REIT like O inside a Roth IRA can be a powerful tax-free way to achieve it. So let me know in the comments below exactly what way do you go. Are you more into steady, predictable income? Do you want to go all in on growth? Are you a mix of the two? Let me know in the comments. Subscribe if you haven't already. And if you like the content, I would love to hear from you all. Let me know if there's some other topics that you'd like for me to go deeper on. I'm always open to learning about anything new. That's sort of the point of this channel. And with all that being said, I can't wait to upload this video. It's pretty cool now that I have a little bit more time in between videos. I feel like I have improved on the quality, my pacing a little bit. I feel like I'm talking a little bit slower. That's one of my biggest problems. I tend to talk very fast. So it's just a nice way to, let's say, look at the videos from a different perspective. So with all that being said, I hope you all have a great Monday, because by the time you see this video, it will be Monday. I hope you all enjoyed your Halloween. I sure did. And I will see you all next time for the next video. And with all that, see you later. Take it easy.